Welcome to Gurtuber. Let's discuss some of the most important finance interview questions. First question is the difference between cash and accrual based accounting. The first type, cash based accounting, shows you the transaction when cash goes in and out of the company. So, a revenue is recognized when cash is received, and expense is recognized when cash is paid. But accrual based accounting is most more sophisticated accounting system where it shows transaction when revenue is earned and mm, expenses when it is incurred, irrespective of money being received or it to be paid or anything. So that is one of the basic differences and most important difference between cash and accrual based accounting. Now let's come to second question. How do the three financial statements connect? Okay, so in in a finance or in a financial statement, we have basically three statements. One is the income statement, and second is the balance sheet, and the cash flow statements. Income statements is further broken down into sales. Sales is nothing but the revenue minus COGS. COGS stands for cost of goods and services. When you subtract COGS from sales, you get the gross profit. And further subtracting operating income and depreciation, you get to operating income, that is nothing but EBIT. And when you further subtract interest expense, you will get the pre-tax income, EBT. And if you subtract the taxes, then you get the net income. And balance sheets, as we know, comprises of assets, liabilities, and equity. Asset plus liabilities is equal to equity. So, equity plus liabilities will give you the assets. Uh, so, mm, under assets we have current and non-current assets. Liabilities also we have current and non-current. Equity will have common stock, retained earnings. Cash flow statements will show you how the cash flows into the company. So beginning you will have cash flow, beginning cash, and further you will have cash flow from operations, cash flow from investing, cash flow from financing, and net change in cashes uh, to account for the differences. So how do these statements, the three financial statements, connect? When this question is asked, you need to understand that depreciation is linked to the non-current assets under balance under the asset section of the balance sheets, and in turn, it is further linked to the cash flow statement from cash flow from operations of depreciation and cash flow from investing under capital expenditures. And how do you say that? Because a property, plant, and equipment formula starts with beginning property, uh, plant, and equipment added to capital expenditures and subtracted by the accumulated depreciation. Okay. Net income links to the balance sheet under the equity section of the retained earnings and under in cash flow statements under the cash flow from operations of net income. That is how we come to the formula. Beginning retained earning less net income, subtracting the dividends give you the ending retained earnings. So coming to the third question, how would you assess a capital investment? Under capital budgeting, we have various ways of assessing whether a capital investment is worth the investment. One way is net present value. Net present value is denoted in the currency value, whether it is dollars or rupees. So when you do the budgeting, and when the net present value of a certain project or a certain investment is above zero, then you accept a capital investment as worthy of investment. If net present value is itself is zero, then you reject that capital investment. Same way for internal rate of return, IRR is represented in the percentage of return. If IRR is greater than the discount rate, you accept a capital investment. Same way, when it is below the discount rate, we reject it. And another way is payback period, where it is measured in the number of years capital investment you will be receiving the capital invested. Okay. And the final question for the today's session is, what is EBITDA? This is one of the most commonly asked questions. You can simply say it as it is earnings before interest, tax, depreciation, and amortization. Is most popular question from the income statements. EBITDA is calculated as net income plus taxes plus interest expense plus depreciation and amortization. So that's it for today. Hope you had a good recap of the interview questions. I'll come up with some few more parts for the in this series. Please stay tuned in. Thank you.